So we'll begin with a history of the forensic alpha model, and even a step before that, the history of fraud detection using forensic accounting and governance. Then we'll get into the forensic alpha model results and look at optimizations which isolate the FAM signal. Let's start at the beginning with some background. Let's remember 2002 and the fraud epidemic that struck the US financial markets. We all remember the names: Enron, WorldCom, Tyco, HealthSouth, Global Crossing, Adelphia, and many, many more. We saw NASDAQ drop from 5,200 down below 2,000, and we also saw the big five accounting firms go to the big four when the largest accounting firm in the world, Arthur Andersen, had to close their doors because of their involvement in some of the largest frauds in the world. This fraud epidemic was the catalyst, if not the inspiration, behind the first model we ever produced called AGR, or the Accounting and Governance Risk Model. AGR was the first quantitative model which made use of massive data in order to identify the similarities in accounting and governance behavior of fraudulent companies. It's these common threads in behavior that we still to this day refer to as the fingerprint of fraud. AGR was a model trained exclusively on SEC enforcement actions of accounting fraud and used only forensic accounting and governance metrics to find these common threads. So there was no usage of fundamental analysis, and in many ways, forensic analysis is the precursor to fundamental analysis. Forensic analysis and AGR take one step back from a fundamental analyst point of view by measuring the likelihood that the information in the financial statements is in fact inaccurate and unreliable. This creates a continuum from total transparency to opacity and ultimately fraud. Well, as it turned out, lucky for us, AGR was and still is very good at what it set out to do. It predicts with great efficiency accounting fraud as enforced by the SEC, securities class action litigation brought on by shareholders, and material financial restatements for the auditors. The chart below spans the time period from 1998 to the present, and we can see that the worst rated companies, right here, by AGR, have 13 times the incidence of SEC enforced fraud as the best companies, right here. The AGR database of forensic accounting and governance metric operations and our sophisticated peering mechanism are the backbone to the forensic alpha model. So what are governance and forensic accounting metrics and metric operations? In terms of governance, some examples are executive insider stock sales over total equity. We'll look at the trailing 12 months, compare that to peers in an appropriate way, and flag it if it's unusual. We'll also look at things as CFO and CEO total of incentive pay divided by their annual compensation. We'll look at the number of interquartile ranges from the industry median and measure that against the peer group. We'll also look at some high-risk events like the number of restructurings or M&A activity, divestitures and spinoffs. We'll also look at things like the number of officer changes and the percent of the board that are also officers, things like that. On the accounting side, what we do is, in fact, we don't make use of ratios, but in fact we take operations or little learning algorithms on top of ratios. So one example would be taking accounts receivable over sales, looking at the 2-year volatility in that by taking a univariate regression over 8 quarters, and taking the error term from that univariate regression and then measuring that number against its peers. That defines the volatility of one of these metrics, and that is consumed as a metric operation. We'll also take the 1-year change relative to peers in our accounting metrics and measure that relative to peers. And finally, we'll take the current period industry comparison, or in English, the number of interquartile ranges from the median, and compare that to peers. These metric operations are the basis to the AGR database, and it's the AGR database that drives the forensic alpha model. But there's a secret about AGR, and it surrounds the SEC and how SEC actions fail to capture the entire picture. And let's see why. First, new academic research tells us that the SEC only catches about 1 out of every 7 frauds, or said differently, the SEC misses about 85% of frauds. In an anonymous study done by Ernst & Young for their own clients, they found that approximately 50% of their own clients admit to having misrepresented accounting in the last year. Think about that. Half of the companies they audit. Just to be clear, I'm not casting aspersions on the SEC. The SEC acts as a policing commission by acting as a deterrent to fraud. So they'll catch a $1 million market cap company, and then they'll catch Apple for options backdating. The message, of course, is simply that the SEC is watching everyone. But the reality is they only catch a few of the frauds. And there is an impact on the ability to predict stock returns that result from this reality. Specifically, the data set of fraud is obviously incomplete if you use SEC actions. It turns out using a model built to predict fraud has other impacts on the ability to predict stock returns as well. First, we're measuring an implicit relationship rather than an explicit one. So if we want to predict equity returns, we should actually look at equity returns rather than fraud. Second, AGR didn't capture the interaction of metrics and the reality that their weight on a model is in fact a function and not a number. I'll go into detail on this soon. Finally, the SEC only has purview over the United States. That means when we apply the model to Western Europe, Asia Pacific, or Japan, we're implicitly stating that fraud in the United States looks exactly like fraud in other regions, and it turns out that's only about 70% right. Just to come back to this interaction example, let's pretend we found out that a stock was issuing a stock buyback. If we were looking at a univariate analysis, we might say that's good news. But if we got one other piece of news, which is that the CEO was also selling shares at the same time that the stock was buying shares, we would probably reverse our decision 100%. One interaction would reverse the signal of the metric. Can you imagine how many interactions there would be if we had 100 metric operations in the model? Finally, we improved upon AGR by using something better than an odds ratio, since we're not trying to predict an event. We're not trying to predict an SEC enforcement action, we're trying to predict stock returns. It's a new world, and the new world is the forensic alpha model. It's the implementation of the accounting and governance risk models database, the AGR fraud database and metric database, to build an equity model. This new model is called FAM. But before we talk about these improvements, I want to emphasize one more time the point that FAM has access only to the identical AGR database and sophisticated peering mechanisms. That's the same repository of forensic accounting and governance metrics that AGR has access to. It's the identical theme that the continuum from transparency to opacity is in fact a continuum of good stock returns to poor stock returns. Here are some details on how we built it. The first improvement we made is that rather than using SEC actions, which we now know are missing the lion's share of the data, we used large stock returns. So what we say the SEC doesn't catch, we believe the equity market does catch. For purposes of the FAM, we used companies that saw quarterly stock moves of absolute value greater than 10%, so up or down. But there's one caveat: we excluded the biopharmas because we're looking for stock moves that can be explained by this transparency opacity continuum, not product failures or clinical trials. After selecting only the companies which had large stock moves, we then trained the model only on the top 20% of returns and the bottom 20% of returns. So in totality, we're looking at stock returns which are always greater than 10% in absolute value over one quarter, and then only the top 20% of those and the bottom 20% of those. The FAM is designed to have information about 40% of the market, the top 20% and the bottom 20%. The second improvement we made is that we can now treat each region separately, since we're no longer tied to the SEC's purview. And does that make a difference? It does. It turns out that the North American model has 98 metric operations, while Western Europe has 83 metric operations, and Asia Pacific has as many as 122. While there is about a 70% overlap, now each region's model can explicitly reflect the realities specific to that region. Our third improvement is replacing the odds ratios with a statistical measure called Summers's D. Summers's D is a non-parametric statistic, or in English, it does not depend on an assumption and a probability measure, like the normal distribution, for example. It turns out that this measure has been shown in recent academic research to be more informative than the traditional practice of reporting p-values, like odds ratios or correlations. The final improvement we made was creating a model that allowed for interactions between metrics by using a supervised learning algorithm called a neural network. To some of you, that's an old term. To some of you, it's totally new. I think the best way to explain the power of a neural network and interaction is to give a very simple example of how a small neural network could be built. In this case, we want to see the importance of a stock buyback. In other words, is it good news or bad news, and by how much given some other information? So, we have this information that there's stock buyback. We now learn that the CEO is selling shares into this stock buyback. So what we once thought was some good information is now bad information. What if we also had other information about the chairman and the CEO being the same person or not? Or if the chairman was buying or selling shares? Or what the CEO's compensation structure was? Or if other executives other than the chairman and CEO were selling stock? Or we look at the accounting, like if gross margins are irregular relative to their peers. The point is, we would end up with a highly sophisticated interaction, which means the weight of every metric operation in the model is not a number, but in fact it is a function. And even further, it's a functional. It's a function that takes as an argument a function. More details on how the neural network works can be found on the white paper or our prior webinar on FAM in general. I'm going to move past that and get to the details of our Western European model. So let's talk about the FAM Western European model. First thing I want to talk about is very simple. There's no such thing as overfitting in this model. After selecting the statistically significant forensic accounting and governance metrics using our univariate analysis, and then applying a neural network, which allowed for interactivity, we ended up with a model. But let's take one step back. What did I use to try to predict returns? Very simply, I took companies from 2006, 2007, and 2008 with market caps between $200 million, or in Europe, the European case, 200 million euros, and 100 billion euros, which moved plus or minus 10% in absolute value in one quarter, then only the top 20% of those returns and the bottom 20% of those returns. And I applied that to all companies between 2006 and 2008 of all market caps, of all stock moves, and then to 2009, 2010, 2011, 2012, and so far the first 9 months of 2013, which were totally out of sample. Said differently, as I've highlighted here in red, and possibly the most important thing about the forensic alpha model is that the model has been built on approximately 8% in sample and 92% out of sample. All of 2009, all of 2010, all of 2011, all of 2012, and all of 2013 are 100% out of sample. There is no overfitting. In fact, if I were to give you each of these 5 samples and ask you which one of them was the in sample, you wouldn't be able to tell me. A few of the other implementations of FAM are how we deal with market cycles and how we deal with industry bias. Again, I refer you to the white paper or our prior webinar on FAM to see those details. Let's look at the impact on performance, the Western European Forensic Alpha model, and an optimization. First, let's look at results prior to an optimization. We'll see that the top 5% of companies in Western Europe between 200 million euros and 100 billion euros returned around 8% compounded annual growth rate, while the worst companies returned negative 11%. The benchmark during this time period returned 2%. So we see significant outperformance from the top companies, significant underperformance by the worst companies, a 19% compounded annual growth rate difference. But one thing I do want to draw your attention to, note that FAM on its own is not only able to predict better stock returns, but the companies that outperform actually have a lower standard deviation or volatility, whereas the worst rated companies naturally have a higher standard deviation of returns or volatility. This fact will come into play into our optimization because I will not want to constrain the volatility portion of our FAM signal, but rather I'll want to constrain other portions. Just a quick review. Again, our unoptimized results by year for FAM in Western Europe. You can see on the right-hand side, every single year, the top-rated 5% of companies outperform the bottom-rated 5% of companies, regardless of the market cycle. You can actually see the signal getting a little stronger in our out-of-sample years. But how much of this return is purely from the FAM signal? That is, we see a dramatic outperformance, but we want to know how much actually is coming from FAM and how much is due to other market factors. So let's do an optimization. This is one optimization I ran. It's one of the most conservative ones I ran, but I want to isolate the FAM signal as strictly as possible. First, the results. These are results for the large cap Western European FAM portfolio. So we're talking about companies between 750 million euros and 100 billion euros over the 7-year period from 2006 to 2012. We can see our optimized results had an active return of 10% a year with 8% standard deviation of returns, where the benchmark, the index, returned only 2% with 19% standard deviation. So we're looking at 400% outperformance relative to the benchmark with 60% less risk over a 7-year period and an information ratio in large caps of 1.25. Let's look at our optimization and how we got these results. So let's look at the optimization on the style constraints. The optimization's goal was to minimize risk. The styles that I wanted to minimize on, or that I was willing to constrain, were leverage, volatility, medium-term momentum, value, exchange rate sensitivity, growth, size, liquidity, and short-term momentum. But let's remember one thing. When we looked at the raw returns for FAM, we saw that FAM had a unique ability to choose companies which had low volatility, low standard deviation of returns, but still outperformed the market, which is the opposite of what you expect. In general, in finance, you get lower risk and lower returns. So in my optimization, which is just one of an infinite number, I decided to leave volatility and leverage unconstrained and to only constrain the medium-term momentum, the short-term momentum, value and growth, exchange rate sensitivity, size, and liquidity. And again, we believe FAM has a unique volatility and leverage signal. That is not a risk I chose to constrain. So let's take a look at the optimization results just from style, and then we'll turn to sector. We can see overall, if you add up the contribution to returns from style, we're looking at 3.32% a year, while the portfolio returned about 10.2% a year. But again, recall, we didn't want to constrain leverage and volatility in this one optimization. We wanted to leave them alone because we believe that the FAM signal for leverage and volatility is in fact unique and intended. So while style has a 3.32% effect on returns, if we remove volatility and leverage, style only has a negative 0.08% effect on returns per year. So summing up these numbers. The conclusion: when we eliminate the unwanted style risks of momentum, value versus growth, exchange rate sensitivity, size, and liquidity, the FAM signal is 99.92% pure, or said differently, 99.92% unexplained. This is one of the most remarkable findings I've ever seen. Included in this optimization, of course, was sector constraints, in addition to the style constraints. Let's take a look at what our optimization results were with sector as well. Again, this is all the same optimization. This time we're looking at the results for sector. We can see that no one sector had more than a 0.47% contribution to the return per year. In total, sectors explained about 0.53% of the return. Keep in mind, this is per year, and the annual return of the annual active return was 10.2%. So said in English, the sector bias from FAM after optimization has a 0.53% effect on returns, or only about 5% of the return in the portfolio. In totality, the conclusion is that when we eliminate the unwanted style factors and all sector risk, we find that the FAM signal for large cap Western European companies is 94.9% pure. Again, one of the most remarkable findings I've ever seen. So said differently in English, when someone asks, I see that your optimized portfolio outperformed the benchmark by 400% and had 60% less risk while outperforming 4 times. The part of that return that came strictly from FAM and nothing else that can be explained is approximately 95%. Now this is just the result of one optimization, and of course there are many optimizations you could run. The one I ran in this example is actually quite risk averse, as I tied things down pretty tightly. I'll show you the results of some other optimizations I ran in summary status. Again, this is the large cap Western European world between 750 million euros and 100 billion euros. That benchmark returned 2.02% per year, compounded annual growth rate, and the benchmark risk was 19%. I optimized a portfolio here with a little less tight constraints, found a portfolio which returned 19.66% with 11.07% risk, yielding an information ratio of 1.58. The original information ratio we saw on that highly strict optimization was 1.25. I did another strategy which was a little more risk averse than strategy 1, but certainly more risk loving than the optimization results I just went over in detail, and we saw 17.88% return with 10% risk and an information ratio of 1.57. So these again are the results of a few other optimizations I've run. There are infinite numbers of optimizations we can run, but the point being that you're going to find an information ratio anywhere from 1.25 to 1.6 in large cap Western European companies, with the FAM signal representing 95% or more of the return. So in conclusion, the FAM signal, when optimized, is 95% unexplained by all other market factors. We're talking about all the sectors, we're talking about short-term and medium-term momentum, talking about value versus growth, talking about liquidity, and even exchange rate sensitivity. If we include leverage and volatility in our styles that we wish to constrain, we're still looking at approximately 70% returns that are unexplained by market factors. So FAM provides significant outperformance, 4 to 9 times the benchmark return over 7 years. Significant risk reduction, as much as a 60% reduction in risk while outperforming the benchmark 4x. And most importantly, by far, is that the forensic alpha model is built on 8% in sample and 92% out of sample. 2009, 2010, 2011, 2012, and 2013 are 100% out of sample results, and they continue to show exactly what the back tests have shown. The model is robust, it is consistent, it is built on a small in sample, and it is built on a methodology that should continue to work in the future. For more details on that methodology, I do refer you to our first webinar, which goes into greater detail into how the model was built. Finally, I'd like to remind everyone on the webinar that FAM is available to only a limited number of clients per region: North America, Western Europe, Asia Pacific, and Japan. We're not looking to erase the signal that this model produces, and therefore we are limiting the number of FAMs we will sell per region. Thank you very much for your time, and I hope you enjoyed this introduction into FAM and a Western European optimization. We will do further webinars on North America, Asia Pacific, and Japan with similar optimizations and results.